Good morning. Today we are going to talk about the changing roles of financial intermediaries. We all know that banks, mutual funds, pension funds, insurance companies, they are all called financial intermediaries. They act between the issuer of the equity and the bond and the regular investors like us, or even the qualified institutional buyers and the larger investors as like. So, under the same circumstances, we have to understand whether their role is changing over a period of time or their role is static. So, firstly, let us understand what is their role as of now. So, as of now, their major role is risk management. Other than that, safekeeping of funds, pooling of funds together, processing the information properly, and obviously liquidity management in the market. Banks are in the forefront of the intermediary business for a long period of time. But the question is, especially in the UK and the US, and even in the emerging economies such as India, that is the situation still the same or the situation is changing? If it is changing, is it for the better or for the worse? So let us see. So here in this particular diagram, we can see how in UK, the banks which were about 58% of the of the financial intermediary around 2007, by the time 2018 has come, they shrunk to about 49%. So it's almost a 10% kind of a decay. On the other hand, the non-banks, which was about 42% in 2007, have grown up to 51%. So that's a significant increase on their part. The other financial intermediaries, including the investment funds, pension funds, hedge funds for that matter, they also increased a lot. So within that 51%, there is about 27% of those funds. So that indicates that not only banks, but the other financial intermediaries are also really doing well, and they are playing a very, very important role, which we will understand during the course of our work today. So now we have to understand what is the problem in the market. Market normally moves well other than any kind of catastrophic event when it comes and hits the market, something like a black swan event probably. Around March of 2020, though it started around December of 2019, but the world came about this coronavirus pandemic, which is infamously called as COVID-19, around March 2020, and suddenly the stock markets saw mayhem across the globe. The bond market saw the yield gaps, the spreads are diverging like as if there is no tomorrow. The bid offer spreads too became extremely volatile between the UK and the US gilts. The yields of the gilts across US, UK, emerging economies, they show uncanny kind of divergence. So this is purely a catastrophic event implication, we can say. So what happens in these catastrophic events is people learn and people forget everything on the financial markets. They behave on panic and they try to put all their money within themselves. So we call this phenomena as dash for cash. People search for a safe haven, relatively a safer bet during these kind of stressed situations. So the panic button is pushed. They forgot every bit of finance, personal finance, investment finance, whatever they learned. And even the most learned and erudite professional also behaves sometimes in a way that defies all the logic. So what they look for? Hoarding of cash. They want to keep the cash with themselves. They dump all the securities that they have. Whether the security is extremely good from the perspective of Sharpe ratio or Trainer ratio, they don't look at anything for that matter. They just dump all the stocks, the bonds, the government securities, everything whatsoever, even the debentures, backed securities, mortgage backed assets. They dump just everything. They just want cash. That's called mayhem, that's called panic, especially during these kind of pandemic and other So we have seen these kind of problem in 2008 global credit crisis, but that was more with a financial crisis. This time this is a more wholesome crisis, as we can put it across. So it was very difficult. So that's why they come out. Banks stop lending to the small and the medium companies, and the small and the medium companies are usually the backbone of any economy for that matter. So if bank stops lending to them, what happens? The liquidity in the market goes completely dry. So as the liquidity in the market is dried up, government has to intervene, the central bank has to intervene to keep the liquidity standards higher. So these kind of problems come and stay, they don't go for a bit while. Sentiment is purely negative. Dash for cash, as I am continuously talking about dash for cash. So situation becomes quite out of control, but the central banks know how to control these kind of tough situations. Here we can see the changes in the repo stock from January 2020 to about say May 2020. We can see around March 10th there is a clear-cut divergence where the non-bank lending cash and bank non-bank borrowing cash, they are just diverging from each other. The divergence is actually pre-March if you see, but around 10th of March the divergence becomes huge, and these kind of divergence is also called as financial Z-man effect. You can refer to Marco Bianchitti's work on financial Z-man effect. These kind of things he has observed around the 4th of October in 2008 when Lehman Brothers crisis came and shook the world, and the global financial crisis was at its top. Similar kind of phenomena has been observed again here. Now let's understand the problem with the liquidity in the market. It's the concept of money multiplier. So as we see, a pension fund is having about £1,000 with it. So it keeps £500 and it basically gets the £1,000 from the bank. Then it keeps £500 with itself and £500 it pushes to the bank. That other £500 it puts into some kind of a money market fund, shares, some kind of a overnight money kind of shares or bonds or mutual funds. And that money market fund further keeps £250 out of £500 into the bank. And again 250 goes to a broker or a dealer. So it's a chain. From broker and dealer, again £125 goes back to the bank and £125 goes to the hedge fund. And from hedge fund again 62.5 comes to the bank. So basically they are keeping 50% of whatever they are getting and they are again lending the other 50%. So they're keeping means they're keeping cash about 50% and they put the money into the bank and the other one goes back for lending. So interestingly, what started with £1,000, it ultimately becomes £1,875 with a 50% kind of a investment and lending ratio. But if that ratio comes down, means you lend more, obviously that 1875 will be higher, and if you lend less, obviously that 1875 will come down. So that this lending ratio, fractional lending ratio, determine that how much the market will have liquidity and how much the market will have market will dry up. So in good situations we observe that this ratio of lending is very high, and in bad situations we observe that this ratio of lending is as low as probably 10, 20, 30%, and 70% of the money the banks want to keep with themselves. So this is the fundamental of this kind of money market debacle problem during these kind of pandemics. So now let's look at the Bank of England reaction and solution. Usually banks, what they do, they cut the rates and they inject cash. So they have a two-pronged approach of cutting rates and injecting cash into the system. So let us go into the detail and understand why they cut the rates. Like in this case, Bank of England has cut rates twice from 0.75% to 0.25% and further another 0.1%. So ultimately the total effect of about 65 BPS drop. The first one happened in around mid-March and the second one happened around mid-June 2020. And stimulus, they have given plenty of stimulus. So two of the stimulus I have mentioned here. One is the Bank of England announced a broad 100 billion pound lending scheme to support the SMEs and MSME sector, because they are the fundamental and backbone of any economy, and they get cash starved during this situation as the bank stops lending. Other than that, they have also started something called as contingent term repo facility, or CTRF, where you can actually give your collateral and you can borrow cash directly from the central bank through a window. So fundamentally, why these two are the regular solution, and why economists and bankers and senior bankers, policymakers alike, why everyone goes to this two-pronged attack of cutting the rates and injecting cash into the system. Let's understand that. So fundamentally, attracting people towards the variable income securities from the fixed income zone. If you cut rates, people will be discouraged from a fixed income zone and they'll go to a variable income zone, that is the stock markets. That's one way of doing it. Second is the borrowing cost comes down, and the borrowing cost comes down in a very, very drastic and significant way. As the borrowing cost comes down, obviously the companies have a sigh of relief. They are relieved. So that kind of relief will cut their weighted average cost of capital down. They can really work with little bit of, they can breathe practically. So these are the two prong from the rate cut. And now injecting cash. People don't have cash. Banks don't have cash. Banks are also holding to the cash, because ultimately banks are not buildings. Banks are not systems. Banks are run by human beings. So if there is a panic, bankers are also under panic. So they are also wanting to holding the cash with the bank. So as I was talking about the reserve ratio goes to the rock bottom. They don't want to lend, and even if they want to lend only to the big guys. They don't want to lend to the smaller companies, the MSME, the SME sector. So by injecting enough cash in the system so that money multiplier does not drop sharply and MSME business gets funded properly, that is a very, very important step. This part is very interesting because we are going to talk about Franklin Templeton mutual fund case. What happened in India, in fact still happening in India as we are recording this video. So it's a real life case. It was about having a US $3.33 billion worth of holdings in the Indian debt fund industry. It was predominantly one of the bigger players, perhaps if not the biggest, before this debacle started on 23rd of April. So what exactly happened on 23rd of April? There was tremendous redemption pressure that was observed in 6 debt funds of Franklin Templeton, and most of them were around the shorter end of the yield curve. So there was on Indian currency, it was about 25,000 crores of INR, Indian National Rupee, was at stake. So this cash crunch was primarily due to the lack of liquidity in the Indian bond markets. Anyhow, Indian bond markets is not very liquid. And on the top of it, COVID-19 came. So Indian bond markets were hardly having any cash. So what Franklin decided, their financial intermediary. So we have to see how the role of financial intermediary changes. So their role got changed. They took a massive call. They took a drastic call. They converted the open-ended schemes into closed-ended schemes. And that attracted a lot of backlashes from every quarter of the investor, of the policymaker, and that attracted a lot of court cases against them. It even went to the Supreme Court of India, and all kinds of tribunals they have to face. But they were steadfast in their approach. They were only telling one thing: we won't sell distress to pay the redemption amount to our clients. On the contrary, we will keep the bonds in safe custody. We will do a safekeeping of the bonds, and once the bonds are giving the correct valuation, then only we will sell it, otherwise not. That was their approach from the day one to even today. So what actually happened? They were criticized. They were put into court by several people at several capacities, but they were very strong to hold their nerve. We must appreciate that, because what happened after that? What happened exactly 1 year and 3 months down the line? That's astonishing. 2.27 billion of worth of US dollars, which is about 71% of the total worth were actually returned to the clients despite all odds. Despite court cases, despite criticism, despite all odds, we have observed that the money has come back. We have to mind one point importantly here, that this is not a paid video or a paid promotion. However, truth remains truth and the fact remains fact, that the money has come back. And as we are recording and going to publish this video on the middle of July, one more tranche is coming. So that probably will take the payoff to the clients close to 80%. Already 71% has been paid. So this is not a no mean feat whatsoever. Investor confidence is restored despite immense backlash from various stakeholders. But as I told, that Franklin is still maintaining the steady status on steadfast approach. And investor commitment is ultimate for them, as they told again and again. And still they're complying with all the necessary and regulatory requirements. They are being helped by State Bank of India while selling those securities, mobilizing the funds, and finally giving the funds back to the investors. So what fundamentally we understood in this entire video series is that whatever happens, whatever is under whatever is under the sun that happens and then comes back, the financial intermediaries play a very important role even now. In fact, their role have become even more crucial. Their roles have changed, but it has become even more crucial today. So thank you for watching this space. More videos of these sort of economic understanding and economic analysis are heading to your way. Thank you once again. Bye bye.